Like, not how much it costs to buy, but how much it costs you in general to watch it.
Oh, you mean like in your time?
Yeah. How much does it cost you to watch that TV
So
thing?
you're saying of your 16, 17 waking hours, you maximize all 16 or 17 of that. You don't spend any time just for yourself.
It's not about maximizing. It's about not watching TV.
Yeah, I just said not watching TV.
Okay, so what are you substituting watching TV for then?
I watch YouTube.
Yeah.
Welcome to Drunk Real Estate. Grab a drink and enjoy the show.
Hey there, and welcome to episode 24 of Drunk Real Estate. I am Kyle Wilson, Ashley Wilson's husband, and I am joined on location in California by two members sitting together at the same table. One's texting, the other one's paying attention, starting with Mauricio Raul. How's it going, Mauricio?
What's going on? I'm in a good mood today.
Why is that?
Because I had a great weekend in fantasy football, whooping your butt.
We're gonna go there again. I'm 7-3. You're 4-6 and currently out of the playoffs. And you're trash talking. Is that how this works?
I beat you, man. I'm 4-1. I should be 5-0. Serena, that was not a well-earned victory last week. But anyway, we're good. I'm here in SoCal. My partner Bethany LaFlamme's house. Therefore, I am drinking Bubbles, and she's the host of Bubbles with Bethany. So I'm drinking a little Schramberg Blanc de Blanc and candy from Halloween.
So that whole text before, we were like, oh, which one of these bottles of wine should I drink? I was just for show. You weren't actually drinking any of them.
That was Jay who's doing that. I don't know. You don't really pay attention, but
yeah, I think that was me that sent all those texts.
Oops. AJ, how's it going, man?
Going good. I was hooked up here with Monster energy drink. This is one I haven't had in a long time.
Was that the peach?
The peach.
The peach. That's good, man.
Yeah, it is good. I'm thoroughly enjoying it. So thanks to Bethany.
Yeah, thanks. Shout out to Bethany for hosting us, the Drunk Real Estate, half of it.
Just crashed her house here, and we're just like, we're doing this.
You guys look good. You got like the whole professional setup with the really nice cameras, and Mauricio's all dressed up, showing some chest. It's looking great.
Oh yeah.
Jay, how's it going over there?
I am exhausted. I've been drinking already for a while. I thought Mauricio was starting early. He said he was starting early today, so I started early today. So I'm exhausted and buzzed and doing well.
Yeah. What did you end up drinking? Did you pick the Portuguese?
Yeah. So I sent a bunch of pictures. Did I want to go with a bottle of French, a bottle of Italian, Spanish, Portuguese, or Argentinian? And I realized I had 4 bottles of Chianti, which I don't really like Chianti, but I had 4 bottles, so I went Italian tonight with the Chianti.
Whenever I hear Chianti, I always just think
beans.
I always just think of a
fava beans.
Yeah, exactly.
Silence of the Lambs for anybody out there that's younger than Kyle.
Hey, I'm not that old. All right, well, let's get into this.
Wait, what are you drinking?
I am going back with an old classic. I've got a little bit of clear here. Went with the water.
Oh my God, we're gonna plug this thing again.
I'm not plugging it. I just
no sugar, no carbs.
I just like it. And it matches my shirt, like the coloring, and like I thought it'd be cute.
I'm gonna make some Premier Law Group wine, and I'm like, I just like it. I just love it. It's the Premier Law Group wine. It's the greatest wine I've ever had.
All right. Well, let's get into this because we had a lot of updates going on this week. We had CPI, we had the 10-year just dropping, we had some Fed speeches. So we figured this was another great week for a economic update. So Jay, why don't you give us a rundown of what's going on?
It was actually a fun week for an economic update. So we started out last week, basically Jerome Powell getting up and after like some not so great economic news, basically things look like they were still on fire. Powell gets up and basically sends the message that we may not be done hiking rates, kind of led everybody to believe that come December, we're going to see another rate hike. I think everybody kind of got all fired up and concerned and just all kinds of stuff. And so then today we get inflation numbers for last month, for October. And surprise, surprise, inflation for not core. So if you include housing and energy, or I'm sorry, food and energy, zero. We had no inflation last month. Doesn't mean prices aren't ridiculously high, but according to the government's numbers, they did not go up last month. So that's huge. That means year over year, we saw 3.2% inflation, which not quite down to the 2% target, but a whole lot less than the 3.7 we were at just last month. Core inflation, if you subtract out energy and food, we were still up 0.2, but that's for the month. So annualize that, and that's 2.4 for the year, which is actually pretty close to the 2% target. So all in all, it looks like inflation, at least for 1 month, was a hell of a lot more under control than it's been the last couple months. That's really good news. It sends the message that maybe the Fed doesn't have to hike. That led bond yields to fall. Basically, people thinking, okay, we're not going to see another rate hike. So lots of people buying treasury bonds, bond yields falling, which is leading to mortgage rates falling. Mortgage rates are down about a half point since a month ago. They've been down like, 10 or 20 basis points just in the last week. So everything's actually looking pretty good right now in terms of at least interest rates. Don't know if we're going to see a cut anytime in the next couple months, but a lot of people talking. UBS came out yesterday and said they think we're going to see sooner cuts than expected and deeper cuts than expected. They think we could see a couple point cut by March. And I don't know. I mean, I'm acting like this is good news when in reality, this could mean that we're closer to a recession than we previously were. But honestly, I think right now, being closer to a recession than ridiculous inflation is probably a better choice.
And by the way, just give a little props here to Kyle, because I think anybody who's been listening to the show the last, I don't know, 2, 3, 4, 5 weeks, we've been talking about this for a while, but especially on the rents, right? So there's the rental component of the CPI is a lagging indicator. I know, Kyle, you've talked a little bit about this, and maybe you want to talk about it a little bit more, but that lagging indicator has kind of caught up now, and I think that's being seen in the CPI numbers, right, Kyle?
Yeah, I mean, we've been toting this horn for a while because we're in the trenches. We see what the rental market is. We see that they've been basically flat for a long time now, 9 months. We had a little time where they dipped actually down a little bit, and we haven't seen that reflect. I think even the last quarter CPI, they were still showing them as rents were what do they call it? The rent equivalent.
Owner's equivalent of rent.
Right. It was like the biggest indicator for why inflation was what it was. And I was just saying that, like, at what point does this hammer drop? At what point do we actually see this reflected? Because anybody who's in the trenches knows that we haven't seen any inflation in rents in quite a while.
Well, that's actually one of the crazy things. Shelter costs was an outlier in this month's report or last month's report. It was actually up 0.3%. So basically everything else was down enough to kind of pull that average down.
But that's better than 0.7 that it has been in, 0.6, 0.7 that it's been showing, and which has been crazy.
Absolutely. So I think it's probably safe to say that we're not going to see a rate hike in December, barring something crazy happening between now and then. And that leads a lot of people to think that maybe we're done again until early next year.
Well, just in the last 2 days, we've seen you talked about March. We've seen the chances, what the market's predicting, the chances of a cut in March went from like 10% up to like 30%. So that's a drastic change, and that's why we're seeing that 10-year Treasury move so much, because the whole thing before was higher for longer. Well, now it's not quite as long as they were saying before.
But one of the things you mentioned it, Jay, if that's good news or bad news, I mean, there's a couple ways to look at the 10-year yield. And the way I always look at it is if the yield is dropping, that means people are buying the bond, right? So the demand for the bond is high. And so the question becomes why? Like, why are people buying the bonds? Is it because of some weird reason, or is it because they're scared? They're seeing that there's trouble ahead and they'd rather have their money in something safe like treasuries versus the stock market or any other investment? And is that sort of a foreshadowing of what's to come? Because generally speaking, the 10-year yield is generally a growth and inflation expectation. And so if the yield's going down, the expectation is that growth and inflation is going south.
Here's the not so well kept secret when it comes to bonds. You can basically make up any excuse you want for why they go up and why they go down. And you'll hear, everybody's concerned, so yields are going up. Everybody's concerned, so yields are going down. We got good news, so yields are going up. We got bad news, so yields are going down. It's if you get creative enough, you can come up with an excuse for why, no matter what happened in the world, is affecting bonds any way you want. And so that's kind of the weird thing when it comes to bonds. But in this case, I think some of it is that the low inflation numbers are leading people to believe that we are getting closer to a recession. And when you get closer to a recession, people want to move out of hard assets. They want to move into something safer. And I think the other thing is simply that if people see that bond yields are likely to get cut soon, people are locking in these 10-year rates. I mean, think about it. If you can get 5% for the next 10 years, you're going to want to lock that in thinking that come 3 months from now, it might be 3%.
Well, and they resell it, right? Like let's be honest. There's a lot of people who are just day trading this. Like they believe it's going to your point, they believe it's going to go down in the next few months. So then they could turn around and sell it and make, 10, even 20% some cases. If you think this is going to go down to the 4% range, you can make 20% on your money in a short amount of time. So there's a lot of, if you see a major move like this where you think, okay, we're going to see a major cut coming up soon, then you might be just day trading this.
Yeah, it's a good point. I mean, we often think of bonds as a flight to safety. People go there because they don't know what else to do. They want a safe place to put their money. But yeah, it really could just be investors who are putting a lot of money there, thinking, yeah, when they go down in a couple months, like you said, Kyle, resell, and it's flipping bonds.
Fair enough.
Yeah. So let's see what else. Jobless claims were about where they were expected last week. Americans are indicating that they think we're going to have inflation longer than expected. So that's been a kind of a headline for the last couple of days. That's starting to really worry the administration because when people start to not, I'm not saying they're not fearing inflation, but when people just accept that inflation is kind of with us for the long haul, that can screw with the economy. People are going to act differently. They're going to act a lot more cautiously, and that's really bad for the economy. And I think the administration also knows that that whether we continue to see inflation or just people think we're going to continue to see inflation, that's going to be bad come the election next year. So I think we're about to see some interesting moves by the Fed, by the government. I think this is a weird time to be heading into a recession when you're a year from an election, and I wouldn't be surprised if we start seeing some weird stuff happening. To
you think the Fed's going to be affected by the election, Jay? Aren't they completely,
I mean, in theory, they shouldn't be. And here's the weird thing. I mean, let's be honest. I mean, it was clear that the Fed was impacted back in 2016. It was clear the Fed was impacted in 2020. I think it's clear that the Fed's going to do things in 2024. But basically, it's been the same people at the Fed. I mean, Jerome Powell was there for Trump. He's there for Biden. So I'm not so sure it's a partisan thing as much as it is just trying to boost their own credibility. And nobody has anything to say to
that. Well, I guess the question then is if inflation's not going to be the thing that moves it, what is the thing that moves it? So is it going to be that recession call, or is it going to be something like jobs numbers next that's going to change it, or is it, in my opinion, is it going to be the earnings season coming up in the holidays here, as far as what people are spending and whatnot? What do you think it's going to be?
I've said for the last couple months, I think it's going to be bankruptcies. I think we're going to see businesses starting to struggle, and that's going to lead to layoffs and higher unemployment. And but there's a good case to be made that people are out of money and they're out of credit, and that's going to be an issue also. But there's nothing saying there can't be two things that lead to a recession.
AJ, you still here, or you frozen over there? You haven't said anything this entire time.
I'm just listening. I'm just so engrossed. I think we're in a weird spot. I think there's just so much speculation right now on what's going to happen. I think on the ground, there's been a very big change in tone over the last 3-4 months. I think people are not nearly as optimistic, and I see people worried, and I think that's showing in inflation numbers, right? I think people are cutting back now. They're actually worried about their jobs. They're actually making real decisions. And that's frankly what you want, right? That's what the Fed's actually trying to get. And meanwhile, you have, you're talking in the mezzanine markets, you have the foreclosure sales on properties have doubled since last year. So I think we're actually starting to see the effects, not just on, okay, interest rates, but actually on the ground and the outcome, right? So what's happening now within the banking system, what's happening with these loans, what's happening on Main Street. And that's resulting in what is now finally inflation numbers that are, not rising and within range. And I think that's a pretty good signal. Now, the question of what the Fed does with all of that, I don't know. I don't know how dramatic they're going to even want to be next year during an election year. They may just put something out and just be like, we got to really stick to this unless something goes awry. So it's this very strange place in the economy. We have an election year. We now have slowdown in the economy, right? We now have inflation coming down, rates though being at astronomical highs that are not sustainable. So those cracks are actually starting to show. We're seeing foreclosures jumps. We're seeing that. So then all of a sudden the Fed, okay, are they going to react or not? It's a really strange spot to be ending the year and moving into an election year. Honestly, I think it's probably anybody's guess at this point.
I feel like they got to have their finger on the button right now. Like the moment that something outside of the realm of normalcy happens, they're going to just immediately hit that button and drop some rates just to ease everyone's, because they're over. They've already mentioned when people bring up like, oh, do you think there's a chance you've overcorrected? And they went from saying no, we're not there yet, to saying, oh well, it's possible. And so that that's in their head that you've possibly already gone. We all know they've gone too far, but they know it too now.
Yeah, and on the consumer side too, we've been talking about it a lot on the pod as well, where savings rates have gone down, and I think people's savings are starting to get depleted. People are starting to dig into their credit cards, right? We talked about that, and now in the last week or so, I saw articles all over all of the publications where people are now starting to dig into their retirement accounts, right? So people are now going into the 401ks. I think withdrawals month over month was up 13%. So at some point, people are just going to run out of places. Their credit cards are going to get maxed out. There's only so much 401k they have. At some point, they can only kick the can down the road so much. And it's just looking at the data points, you can just see where this is going.
Yeah, those, and you're talking about those 401ks. Those are loans too. It's not like they could just take out that
Right.
money and use it. Like they take a loan on their 401k and they got to pay interest on that, and interest rates are high again. So it's just going to create this.
And they can only borrow 50%. So whatever they have in there, they can only keep tapping in and tapping in even to pay the interest. And it's just the data points. You can almost see, It's almost like a train wreck in slow motion, right? You can just kind of see all the data points. And, obviously I was a little bit early on my call, but Kyle, you're coming in at Q1, and I think we all are somewhat on the same page that something it's going to be turning here pretty soon. And maybe this is it. This is the first inflection point.
Yeah, we're still seeing a lot of calls in the back end of 2024. So a lot of economists are calling back end 2024 now, that when they see some sort of small recession or whatever they want to call it. But yeah, I'm still sticking with the Q1.
We're recording this on Tuesday evening, and this is going to get released on Wednesday morning. For anybody that's listening to this early on Wednesday morning, I think 8:30 on Wednesday morning, sometime around then, what we're going to see is U.S. retail sales released for October. Basically, we're going to see how businesses did in October in terms of retail sales, and the forecast is dismal. So basically, we saw 0.7% up last month, which is the equivalent of like 8.5% annualized increase just last month. This month, or for October, we're expected to see a decline of 0.2%.
October's always got to be a relatively slow time. Like, who's buying stuff other than Mauricio for his Christmas stuff? Who's buying stuff in October? Like, they know that Black Friday's coming up. They know that the Christmas season's coming up.
Everybody's busy getting their Christmas trees up and, getting ready for Christmas. Who has time in October to do anything else?
I mean, but in all seriousness, like Halloween candy's cheap. Like, what else is going on in October that people are going to be rushing out to make outsized purchases?
Yeah, I don't know the seasonality of retail sales data, but I will say that it's going to be a big release tomorrow. And if we come in a consensus of a negative, like sales actually dropped, I think that's going to be the next nail in the I hate to say coffin because I don't think we're that bad yet, but it could be the next nail in the basketball.
Well, it's interesting. We were talking about this. I was talking about.
I'm sorry,
this.
AJ. Hold on a second. Did you say
Did you say
did you say a
basketball?
nail in a basketball?
You don't need multiple nails in a basketball. I think one's going to do it.
Wait, we can see where this is going to go. It's like deflating. Now it's going to pop. I'm with you, Jay. We can follow this analogy.
Yeah, but you don't need more than one nail. Like, you can't say the next nail. That's implying there's one nail in there already.
Well, no, I mean until you pull. So if the hole's well plugged up, it's nothing's going to happen until you start to pull it out, right?
Jay, have you ever seen a basketball in your life?
All right. Should we? So AJ touched on this. So should we move on to the Wall Street Journal article? Because I think this is the one AJ was talking about. We didn't really follow up, but there was an article saying the clearest sign yet that commercial real estate is in trouble. And then it goes on in the article to talk about the number of foreclosure notices from lenders on mezzanine loans has never been higher. And is indicating, is this a sign of things to come? So AJ, was that the article you were talking about with the front of the Wall Street
Yeah,
Journal?
that was kind of one of the things it touched on. When we look at foreclosures, when you're looking at distressed commercial real estate assets, we talked on this a little bit, a few weeks ago when we got more kind of into the different sectors and what's going on. I've been having a lot of meetings with some fairly large capital allocators, and it's we're seeing more of that distress stuff, I think, come to the market. We were just talking, you're like, we're seeing now more deals start to come. People are trying to figure out what to do. I think that the clock of burning cash at these high interest rates or decisions, it's the end of the year. People are closing out books, and we're starting to see more where think we're all surprised. I think everybody, including the Fed, how long people were holding on. And we're now seeing that obviously not. It's the highest. So what here? 62 mezzanine loans, which is double last year, all of last year. It's the highest total ever for a single year. So we're seeing it now, right? Like it's hitting. And now to put this into perspective, though, right? We're talking about a very isolated more event in the economy. We're talking directly around like commercial real estate and our industries. But it's kind of when you look at real estate overall, commercial real estate has shorter term loans. These aren't 30-year mortgages. These aren't, these loans come due. I mean, people use interest only, where they have short term, they have floating rates. Those kind of financing structures are common in commercial real estate. 10 years is a long time in commercial real estate. So where a lot of people looking at single family homes or personal mortgages, those are 30 years out. You got a long time to do it. That's not how commercial works. You can only go on for so long, right? There's every year you have huge segments of the commercial loan market that come due. They have to refinance. They have to do something. So right now, I think we're starting to see that, tipping point in the sector where it's like, all right, all of these more distressed ones that aren't they're getting flushed out a little, and it'll be interesting to see the impact of that.
So AJ, especially in multifamily, right? Because in multifamily, the loans, especially the last 3-4 years, have been bridge loans, 3-year loans. So even though usually you're looking at 5, 10, 50-year loans, the last couple of years people have been taking out 3-year loans, and so all those loans taken out in 2021, which is where we peaked, those are becoming due now the last 12 months, and we're right in the thick of that. And so we're seeing that ourselves. We've got a little bit of visibility behind the scenes, and a lot more sponsors, syndicators, operators are coming up against that 3 years, and their options are limited. They can't refinance. They can sell, but cap rates are a little bit higher. So, so they're taking a haircut. So that's become a real issue in the multifamily. And again, commercial is a lot more than multifamily. Multifamily is just a portion of commercial, but those short-term loans are killers.
Well, and it is, but what happened is the economy heats up. You have those prices, and commercial real estate got insane, right? And those high prices don't start to make sense when you're looking at the cash flow. How do we make this work? So a lot of people, what they do is they start to financially engineer returns, meaning that, okay, we can't pay the debt, which if you think about that, you're talking about financially engineering through interest only things because you can't pay a 4% interest, right? That's when you know there's obviously problems. But then, so that what they do is they take shorter deals and shorter contracts to do things like interest only or floating because that takes that interest rate down. That means that they can give distributions maybe, or they can just make the deal work. And it gives them time to get those properties' incomes up. And then they think, okay, we're going to sell it or we can refinance it, but we'll be at a higher revenue. So now we can make it work, i.e. speculation.
Can we talk about what specifically they're doing? So for this article, so this article specifically calls out mezz debt, right? So what you have to understand with mezz debt is a lot of people will use that mezz debt. It's the space between your primary loan, so your number one loan, and your equity. You'll get that kind of mezz piece, and some people put pref equity there. It's essentially the same idea where you have this extra piece where your primary loan maybe didn't give you enough LTV or you wanted to get more, so you go and get this mezz debt, and it's typically higher interest rates. So if you got a 5% loan on your primary loan, you might be paying 7, 8, sometimes even 10 plus on your mezz debt piece, and that'll bring that loan value up to 80% plus. And what I thought interesting here is the article was saying this is the clearest sign yet that commercial real estate is in trouble. But what I don't think a lot of people understand is how mezz debt works. And if they're in second position here and they're saying, okay, these are foreclosure notices is what's up, it's not actual foreclosures. Because what's going to happen is if you're in trouble and you're having cash flow troubles and you have a primary loan and you have your second mezz debt piece, you are most likely going to stop paying your mezz debt before your primary loan. Because what happens is the only recourse that these lenders have is to foreclose on you. But if the value of the property is less than the value of the primary loan plus the mezz debt loan, that mezz debt isn't going to get repaid. So they're basically just beating their chest by saying, hey, here's a foreclosure notice, but the chances of them actually going through with it right now, in my opinion, are very slim. Like we have a good friend, Dave Van Horn. He has a company, PPR, and this is what they do: is they buy non-performing seconds, and they buy first and everything. But with the non-performing seconds, when they buy these non-performing seconds, the first thing they'll do is they'll try and contact them. They don't hear from them. They file a foreclosure to basically like wake up the purchaser and say, listen, we're paying attention. We're going to go through for foreclosure. But at the end of the day, if that foreclosure happens and the value's down low enough, they're going to get wiped out. So they might not even go through with it.
Yeah, I think what it's really, mezzanine and a lot of these were used as bridges. So when you're dealing with the affordability problem, right, that we were having, you have short-term loans and you have a lot of bridge loans, and people were doing these kind of debts. And I think it's a signal that, let's say the foreclosure is not happening by the bank because it's not, but what it's showing is the original structure is non-affordable and people are restructuring debt. So even though a bank might not end up with the property, they're still restructuring the debt, right? And the cap table. So all of a sudden now the restructuring's occurring. There's usually a reason for it, i.e. they can't pay it, or lots of times they have to restructure, get a different loan on the main one, and they're wiping out the mezz because they can't go into a new loan and then pay the mezz back, right? So the restructuring that's going on is there's just weakness in the overall market. So I guess the first domino to what would be the bank foreclosures, these gap loans, these short-term things, that's what we're seeing.
I guess my question though is like, if you're looking at this, and people read a headline of this article and they're saying, oh, here it comes, right? here comes all these foreclosures. I don't see it as that. I see these as these mezz lenders. They are just basically jockeying to try and work something out and try to get something out of this, because they're in second position and they're trying to, you know, hedge their losses a little bit by saying, okay, we're gonna send this foreclosure notice, but I don't think they're actually going to go through with these foreclosures, because then they'd have to write the entire amount off on the books.
Well, and two, the rights associated with it. If they're second, it's not like they can force. They're severely limited. This is like Kyle's saying. This isn't the bank that has the first that's going to actually take that property back. That's not what the mezz.
Unless they
is.
buy out the first, which is tough, obviously.
Yes.
But I don't know if anybody's doing that or not, if they've got some capital that they can go buy the first. But it would only make sense if there's enough room, that there's enough left over to pay them as, right?
Right. But typically these mezz, that's what they're getting. The reason people get the mezz is because it gets up to like 80% like loan to cost a lot of times. So you're getting close to like 90% LTV. And when, to Mauricio's point, these things were bought in 2001, that LTV from then, we've seen it since 2001, we've seen a drop of 20-25%. So that means if you got those loans that brought you up to 80 plus LTV, then that mezz debt could be gone. It could be like the value of the property could be basically what the primary loan is, and the mezz debt value could be right out of there. So I just see this as mezz debt holders just trying to play the only card that they have, and they're not actually going to be able to go through with the foreclosure because they're going to lose all their money.
I think at the end of the day, it really depends on why these properties are struggling. And if you look across asset classes, in the office world, they're struggling because of vacancies. In the self storage world, they're struggling because of, it sounds like, AJ, correct me if I'm wrong, it sounds like it's because monthly rents are dropping. And in the multifamily world, I'm not sure that there's a ton of struggle in the multifamily world, but what we're seeing in the multifamily world, amongst those properties that are struggling, are things like rate caps going up, and loans coming due. And so I think for each of these asset classes, because there's something different driving the distress, that you can't just treat all of these assets homogenously. And for the most part, I don't think banks want to take back assets. I think they learned in 2008 that just willy-nilly taking back all the assets and keeping them on their books or selling them off for a major discount is not going to be good for the banks. And so I think what we're going to see here is we're going to see banks taking a very individualized look at each of these assets and saying, is this something that is fundamentally flawed? There's no way that the operators are going to be able to fix this anytime in the near future, and maybe they're going to have to foreclose on those. But then for the most part, there are a lot of assets out there where it's interest rates are too high, rate caps are too high, some things that likely are going to resolve themselves in the next 6 or 12 months. And the banks are going to realize, I think, that if they can kick the can down the road 6 or 12 months, that we're going to get back to a situation where these operators can get these properties under control, can get their NOI back up, can make things cash flow and pay their mortgage. And I think in that case, banks aren't going to have the any interest in just foreclosing willy-nilly like they did back in 2008.
For sure. Like, you could say that all of these different industries are having their own problems, but fundamentally, though, if interest rates were still 3%, no one will be having problems, right? Like, it's like with the.
Well, is that true in office?
I mean, okay, office is a bit of an outlier, but at the same time, people would be willing to pay more for office still if the interest rates were lower. Like, the problem with interest rates being high, it's a double whammy. Your monthly payments are higher in a lot of these, but it's also, if someone wants to try and purchase that property, they have to get a loan that's much higher interest rate, so they're willing to pay less. So if the interest rates were much lower, then they would be willing to pay more for these properties, and even office would have a much easier time of being able to exit some of these properties and not have these foreclosures, because they could have a little bit of equity saved and they would sell them instead of just letting them go.
That's part of the issue, right? It's like these interest rates back, the last couple of years have been artificially low, right? It's not a market rate. And so it causes people to buy things that they shouldn't be buying, right? It's what the economists call the misallocation of resources, right? And so now that we're back to normal.
Is this normal though? I guess that's, you guys say like artificially low. What's normal?
obviously nobody knows what the we don't know what the market rate is because we're not allowed to see it. But I think AJ, I don't know what you think, but I think market rate everybody thinks is probably around where it is now. I don't think everybody's thinking market rates is it should be at 4 and we're at 6. I mean, it's probably around kind of where it is now.
I actually disagree. So I think that the Fed, they've come out like we're talking about maybe that 2.5 range as far as a Fed funds rate. If people believe that, that means that our 10-year treasury would be somewhere in the same range. And then if you add that 200 bips for, in multifamily in particular, you see that right around 200 bips. Then you add on top of that, that's like 4.5. So
at the end of the day, interest rates being basically at inflation or just above inflation and having them at 3%, 3.5%, especially what we saw towards the last 5 years, that completely drove these assets into levels that were unsustainable. They were propped up by money that was so astronomically cheap. It needed someplace to go. People were getting, the incentives were screwed up and it wasn't in line with fundamentals. I mean, the values that we saw through COVID, through everything else, it was clear they weren't being driven by fundamentals, right? There's just mass allocation of capital trying to get real estate at any cost. The decisions were ridiculous. They were stupid. They were short term.
For an extended period of time. It wasn't just like a couple years. It's like decades. Since basically 08 went to zero, and it was basically been at zero for the last.
Well, I think we need to consider the fact that structurally speaking, we may be in an era where we have to see lower interest rates than we have in decades past, simply because of the cost of debt to the government. So it's possible that, we talk about what's normal, but it's possible what was normal for 50 years is no longer normal. And I hate to be the guy that says this time is different. But I think things have changed and we may have to accept that we're over the next 20 or 30 years, average interest rates are going to be somewhere in the 3-4%, not necessarily the 5-6-7% like we've seen the last 50.
Well, I mean, we're at 8 now. So I think that they found a problem, though, that inflation, I mean, at the end of the day, what we've been seeing with inflation is a result of that easy money, right? So they do have a debt problem, but guess what they are definitely concerned with, and that's Main Street. If they drop interest rates down and do it anytime quickly, we have too much freaking money, right? The printing press has been insane.
That's also money supply. Like they printed a lot of money. So I would argue that's the bigger issue here. And I would also argue, why can't we have low interest rates? Like, I guess like the only reason we're doing high is
you can, but then you got to stop the printing. So they print money by dropping interest rates. That's literally how they do it, right? Debt is printing money. So what they do is they lower it. The lower it goes, the more debt goes into the economy, right? And demand starts to spur. So then when you do that, and then you're also giving government handouts on top of low interest rate. It's like they were using every single lever to dump money into the economy they possibly could.
Yeah, I mean, lowering interest is one lever to get more, but as far as creating money, like that's a little bit different. If you want to talk about quantitative easing versus quantitative tightening, and then with the bond markets and stuff, that's a little bit different. And I would say, like, yes, if they can get to a place where they don't need to do that quantitative easing, and they can lower interest rates. Now, whether or not they would do that is a question, but to me, that's a healthier market.
You can't do both, though. You just can't. The government can't print money and then you have free money available to the market and not result in inflation. That was a theory that they had, which was so ridiculous that they said, no, we're not going to have inflation. It's okay. And
what about 2008 to 2020?
Yeah, that's because we lost $1 trillion and the economy got evaporated through restructuring of debt. So yeah, if we have mass bankruptcies and mass defaults and we structure assets down to the tune of trillions of dollars, that money vanishes, then yeah, we can print off a lot of money. But unless we get rid of trillions, you can't throw trillions on top and have low interest rates. 2008, we lost trillions.
I don't know. That's a good theory. Like I guess like that's it explains in retroactively why that made sense. But at the same time, like I think everyone can agree printing that amount of money that quickly obviously was a huge problem. But as far as to Jay's point, if by just quantitative easing, like slowly over time and keeping interest rates low, and like we didn't have inflation. So like it's there's a lot of different factors going in here. So I don't think we could just point at one thing and say, okay, it only worked because of this.
Well, no, I think actually but we can. I mean, it's pretty clear money supply causes inflation, right? It's known. We can track it. It happens always. Now, the reason why we didn't have it when, by
Except
the
that
way,
time that you're saying it didn't because of the whole like
no, because the money supply shrunk. You're saying that the money supply didn't shrink. It did. In fact, it cratered. It was almost depression level. The amount of money that we lost in 2008, 9, and 10.
right, but then it started growing again. So I guess it's the whole thing like, okay, yeah, I'm going to be right. It's just, how long is it going to take me to be right? Yes,
A
creating
decade.
money.
We're talking about a decade. By the time the money supply caught up, within 10 years, we got inflation from that.
No, the inflation we saw in 2021, 2022, and now, I would argue was not the result of what happened in 2008.
No, it wasn't. I'm not saying it was.
And so I'm not clear on why you think 2008 printing trillions of dollars didn't result in inflation, when the argument is printing trillions of dollars has to result in inflation.
Because we lost money.
Well, yeah, here's the issue. And not that we're going to get into it in this point. Maybe we should dedicate a whole podcast to this. But generally speaking, quantitative easing is not the printing of money. It's the printing of bank reserves, right? So the Federal Reserve can't print money. They print bank reserves. What creates money is it gets lent into existence, which means the commercial banking system has to lend. And in 2008, they didn't lend because they were in so much in trouble that those bank reserves that they received was just to prop up their balance sheet. So there was no lending going on to it. Versus this time around, they're not actually lending; it's actually deficit spending. So it's actually the government that's actually the one that's spending it. So that's that's how the money's going directly into people's things. So look, that's a whole episode. I mean, I probably don't want to spend the next 20 minutes arguing over quantitative easing. But money gets lent into existence. So to AJ's point, when interest rates are down to zero, people want to borrow. And so banks want to lend, and so banks lend, which is what actually creates the money supply. It's the commercial banks that create the money, not the Fed.
But they can only create to the point of their reserves, though, as well. So like they're two different levers.
Correct. But if they're not constrained by bank reserves, so you can give them all the bank reserves in the world, but if that's not the constraint they had at some point is like, well, there's nobody nobody to lend the money to. Yeah. There's nobody that's credit worthy. So it's a two-step process. The Federal Reserve has to print reserves, give them to the commercial banking system, and then the commercial banks then has to lend that money into the economy, and that's what's going to cause the increased money supply. That didn't happen in 2008 to 2021.
All right. I don't want to get too far into this again because I guess like, yes, we could try and say, okay, it didn't work this time and for 10 years and like this is the one reason. And I just think it's a lot more nuanced than that there's you can't just point to it and say, oh, hey, this is the one time that we have this theory and it didn't work this time because of this one thing. Not saying that going forward we can't have something similar happen. So let's leave it at that and we can move on because we had a pretty big thing that's creeping up on us that everyone's all of a sudden starting to freak out all at once. And it was this Corporate Transparency Act. It was actually enacted in 2001. And it was passed to enhance the transparency in entity structures and ownership to combat money laundering, tax fraud, and other illicit activities. But this law, even though it was in like 2021, it's largely been kind of ignored by everyone at first. But the effective date of this Transparency Act is approaching in January 1st, 2024. And now people are starting to kind of wait, this is real, and they're panicking. So Mauricio, I think you did a live about this before, so we're hoping that you have some insight for us.
Yeah, let me give you the punchline before I lose anybody. So if you've ever created an LLC in your life, right? LLC, corporation, any kind of entity. So I'm going to say LLC, but I mean entity. Then this applies to you. So if you're a real estate investor and you bought a property 20 years ago and put it into an LLC, this is going to affect you. And so this actually passed, to your point, Kyle, in 2021. It was supposed to take effect last year, January 1st of 2023, but nobody knew about it. And there was a concern about the fact that if they rolled it out, everybody would not be compliant. I'm not sure that many more people know about it now. But starting in about 50 days, right, January 1st, 2024, basically, if you've ever created an LLC in the past, there's going to be some reporting requirements to the federal government, to a specific government agency called FinCEN, which is Financial Crimes Enforcement Network, right? And basically, if you were a beneficial owner of an LLC or any other entity, right? And beneficial only means either 25% ownership or you have substantial control over the company. So you're the manager, the director, you got a voting block or whatever. Then there's several pieces of information you must disclose to the government because the government's trying to get around money laundering, like you said, tax evasion, all that stuff. And it's basically your name, your home address. Can't give them a PO box, your business address, your date of birth, what's called a unique identifier number, which is basically going to be your driver's license number or passport number. And then you have to upload a copy of that driver's license or passport number. And that's for anyone who, again, is a beneficial owner of one of these LLCs. Now, the LLC itself also has to report. So they're called a reporting company. So the LLC is going to have to file, their name, their DBA, and their address, and their unique identifying number, like an EIN or whatever. But and there's some other stuff as well. I don't want to get into the weeds too much. So really, the public service announcement of doing this is to make sure that you're aware. If you're a real estate investor, I can't imagine you're a real estate investor and you live in a world that you haven't ever created an LLC or some kind of an entity. And if you create one starting next year, you have right now 30 days to comply with this and give all this information to the government. I think that's going to get extended to 90 days because the government doesn't have their act together. So I think there's already a proposal by FinCEN to extend that to 90. But let's just say,
won't it
right
just
now.
become part of the creating the entity process? Like it'll be like
yes, and what's more important, I'm glad you brought that up because the other party that has to report is the party that actually files the LLC. So when we, as the law firm, Premier Law Group, we file the entity, we are the applicant. And so we have to comply too. So we have to provide our name and address and phone number and driver's license or whatever. And so if we don't, we're on the hook for penalties. And we'll talk about penalties in a second. And so we're not going to, and everybody I've talked to isn't going to create new entities until they have all that information from the client. Because if we create the entity and then say, hey, we need your driver's license, and they're like, well, I don't want to give you my driver's license, then we're going to be on the hook for violating this law. So it really is a pain for the applicant, but it's just, again, it's supposed to be private, right? It's not supposed to be public. It's going to be only for law enforcement. Your bank's probably going to require it, but the bank's going to have to need your signature to get this information. But it's a pretty overreach on the government in terms of, all the privacy information you have to give them. The penalties can be on the civil side, $500 per violation per day, which could be hefty. And on the criminal side, up to $10,000 and 2 years in jail. And if you willfully don't comply, that goes up to 5 years in jail. And I think 250 grand. So they're taking this pretty seriously. And so, as you guys know, ignorance of the law isn't an excuse. So I think a lot of people don't know about this. So I've been on a mission the last couple of weeks, actually, and I'm going to continue through the end of the year to just get the word out. Whether you file this or you have your attorney file it or whoever usually files your entity, they should be able to file all this information with FinCEN. But you got to file it because if you blow this, there's hefty penalties. And anytime your entity changes, right, if there's a change in beneficial ownership, if there's a new manager or new owners, then you've got to amend that. And you've got to amend that within 30 days.
You just have to do it once, though, right? You file it once, and then if there's changes, you got to change it.
Yes, and the good news is, I will say one piece of good news is that if you create a lot of LLCs, when you do it the first time, you're able to get sort of an identification number, so that the next time you just provide the identification number, and they already have your. So you don't have to upload your driver's license every time or provide it, but you do have to do it the first time. But the tricky part is, if you're part of an LLC, like a syndication, for example, or a business where you have multiple owners and maybe you're not the manager, maybe somebody else has control of the entity, they're going to be responsible for making these filings. And if they don't, you as the owner may be on the hook for that. So you just got to be aware. At the end of the day, you've got to be aware of the law, right? This is kind of a primer. I don't want to bore you guys to death, but make sure you're aware of the Corporate Transparency Act. It kicks in January 1st, 2024. And basically, if you've ever filed an LLC. So if you've filed an LLC in the past, you have 1 year to comply. So new LLCs, 30 days, old LLCs, a year. But you may have 30, 40 LLCs or 10, 20. You know, I know AJ's got like 6,000.
Just think about some of these syndication LLCs that we have, where it's like, you know, one entity at the top that's owned by another entity that has, you know, 8 members in that entity,
Yep.
and those 8 members, some of those are owned by family trusts that all of a sudden in that family trust is owned by somebody else, and like you're all of a sudden 8 leagues down under the sea before you get to a real person.
Yeah, that's where it gets complicated.
I have questions. Okay. Let me start with this one. So I own 20 something LLCs across 5 states.
I have a special package for you, Jay.
$1 million.
One, let's say that I was one of the few people that in the world who doesn't listen to this podcast, and I didn't know about the Corporate Transparency Act. Who's going to tell me about this? Like, where would I be hearing about this? Where do I go to submit this information? If it's across 5 different states, do I have to go to the
It's a federal thing, so it's not a state by state. So there's a system
Okay.
called BOSS, BOSS, which is called stands for the Beneficial Owner Secure System. Which, if you know anything about the government, it's probably the opposite of that. But the Beneficial Owner Secure System, BOSS. Guess what? The system is not up and running yet. The government has not fully implemented it, which I think is
Well, that's like I'm just saying logistically there, like who's checking these things?
Oh, you just go to Reddit. So if you go to Reddit, there's some guys on there. They've got great threads.
Let me throw this out first for logistically. Logistically, you know how many LLCs there are in the US? 21.6 million LLCs, 23 million sole proprietorships. So, like, if we want to talk about back when we were freaking out about, oh, the IRS is going to hire 87,000 new agents to try and go after taxes that everyone's filing, and you know what percentage of people actually get audited, there's all of a sudden 21.6 million filings are going to happen over the next year. Who the fuck is checking these? Like, and what do you pick which ones are checking?
Yeah, obviously I don't know how it's legit going to work, but I can tell you this. The government, well, first of all, whoever filed your LLC, I pretty much guarantee you is trying to get a hold of you. They're probably sending emails out, letting you know about this. I've personally probably created over 1,000, probably 2,000 LLCs. And so we've got that on our database. We're sending out emails to everyone, letting them know about this. Now, who knows if I got the right email from 10 years ago, 15 years ago, but at least we're making an effort. But what's going to happen, I think, is the government, FinCEN, is going to be able to see that these LLCs have not complied, and they're going to, remember, you have a registered agent. So how are you going to find out? You're going to get a notice from FinCEN that's going to get sent to your registered agent, who's legally entitled to receive paperwork for you, and then your registered agent is going to pass that information along to you. The problem is, if you don't know about it, you might end up saying, crap, I haven't done it in 2 years, $500 times 600 days. Look, it's no different if you guys have entities that are offshore, for example, or bank accounts offshore. There's all these requirements for you to file notice requirements for the federal government, letting them know, hey, I own an LLC in this country, or I have a bank account, or I have control of a bank account. And man, if you don't comply with that, it's like $1,000 or $10,000 a day per incident per day. So it's pretty onerous. And so this is kind of an extension of the international requirement. They're bringing it on shore and requiring you to do all of this in the name of, anti-money laundering, tax evasion, and other, quote unquote, other illicit activities.
And you can also get put in jail for 2 years, by the way. That's another.
Or 5. By the way, I'm going to do my plug now. I think I need to update my book, 5 Things Every Syndicator Must Know to Stay Out of Jail. I think I may have to add this one, knowing about the Corporate Transparency
So
Act.
it's obvious Jay showed up without being prepared for what the Corporate Transparency Act is.
I'm here to learn. I mean, and I have questions, and if I have questions, our listeners have questions. So for anybody that's running a syndication out there, I mean, I have a syndication entity. We have multiple syndication entities. I imagine AJ has multiple syndication entities with dozens, if not hundreds, of members in those entities that own some percentage of that.
But they're not beneficial owners, though.
Yeah, let me ask you this though, Jay. How many of your investors own 25% or more of your syndication?
Okay, so that did you say that? And I
Yes.
just missed it. Okay, I'm a little bit.
He's drunk.
I've been drinking. Okay, so 25%. That makes things a little bit easier.
Yeah, I actually don't. I think even the sponsors, right, the operators are not going to be caught in the 25% because most syndications are 80-20. So the sponsor team as a whole owns 20%. Maybe if it's a 75-25, but if you've got 2 or 3 or 4 people, you're owning, right? You're owning 3%, 5%, 8% of the company. So I don't even think syndicators will be on the hook for the 25% piece. Where they're going to be on the hook is the substantial control. So who in the sponsorship team actually has control, which is most likely going to be the manager of the manager, or the whoever's controlling the GP entity. The GP entity is going to be a reporting company in and of itself. So you're going to have to file everything on behalf of the entity. And then whoever the managers or the GPs of the GP, those 2 or 3 people are going to be beneficial owners, and they're going to have to file this.
So Kyle and his wife, they're going to deal with all my shit.
I know Mauricio is going to deal with all your shit because Mauricio is our syndication attorney, and that's why you pay an attorney.
That's
Because you don't want to figure this out. But I think we're skipping over the whole, like, this is America, and like the land of the free, and all this stuff. And I can't believe there hasn't been more uproar over the fact that we're all of a sudden having to give the government all of this information.
Nobody knows about it. Again, I own 20 some LLCs, and this is literally when Mauricio brought this up a week or 2 ago. It was the first I've heard of it. And he said, yeah, we're going to get emails and notifications and letters. I've got nothing.
Well, I had 2 thoughts. So like, obviously the first thought is, oh, this is going to be annoying. And then my second thought is, well, what about all these asset protection things, right? So like, I have asset protection entities, and one of the major underlying things about an asset protection entity is you do it in a state where basically the only way people can figure out that you own this entity is they have to like subpoena your registered agent. Like, and like now all of a sudden I'm going to have to like be willingly give all this information just to some random entity, which I'm sure is the highest security, will never get hacked or whatever, and won't get passed to any nefarious people. But when I'm looking down, like, first, this is a shit show already. Like when you want to ask questions like, okay, what if I close down an entity? Do I have to report when I close down an entity?
No. So that's a good point. So that's a good best practice. If you have a company out there lingering that you're not using anymore and you just haven't gotten around to shutting it down, shut it down officially.
But do you have to notify what's FinCEN if you close down the entity? And they're like, there's been no, we haven't gotten that far yet. Is basically their answer. They haven't figured that out yet. And so like this is happening in a few months, and like we're supposed to trust that we're just giving all this information to them and that no one's getting it that isn't supposed to. And like there's a big thing. This is not publicly available information, but it's available for law enforcement, which I'm sure they have a very, after the whole Twitter thing and whatever, they can't just, go in and subpoena willy-nilly whatever they want. U.S. Department of Treasury, tribal law enforcement can get it, apparently. They could be shared with foreign countries, which is another thing. And then it may be disclosed to financial institutions with consent of reporting company. So like, it's like, I don't know. I just don't like, I spent a lot of money trying to figure out all these asset protection things, and now I'm just giving money to people.
That makes sense. The tribes need to know exactly how many LLCs I have and who
So I have another question. So when I stop using an LLC, if I think there's any legal exposure, I will shut it down. I will
dissolve it.
Dissolve it. Thank you. Sorry, I'm
drunk.
Things are processing a little slower at this point. I'll dissolve it. But if I don't believe I have any legal liability in an entity, my way of dissolving it is I stop paying the LLC fees for the state, and it goes into non-compliance, and nobody ever bothers me anymore. And they tell me that I no longer have the LLC.
Well, correct me if I'm wrong, Mauricio. There is a provision in there. It has to have like done something in the last 12 months, right? Like it has to have transacted, or something has to have like actually happened. If it owns nothing and nothing has happened within the last 12 months,
I would just shut it down. If you've got an entity out there, I know what Jay's saying, that we've even told people, like, just let it go. Like, especially like in Wyoming, after 2 years, it gets administratively dissolved. So just let it go. It'll eventually dissolve. But now the strategy's changed. Now we're in 2024. This is a new year, a new era, and you should dissolve it. So if you've got entities, I would go file. Like if I had a Wyoming entity that I just let go, I would go and it's super inexpensive. Just go file your dissolution papers, pay the $50, and you're done.
I don't even remember all my entities. Mauricio, you need to fight this. I'm sorry.
Well, we talked about
you're my attorney. I need you to go get this law overturned.
We talked about lobbying last episode. if we raise $15 million in a syndication, which we'd have to file beneficial ownership on, but if we raised $15 million in a syndication, we'd be in top 10 lobbyists out there. Like, let's go lobby against this.
Okay. I'm angry now.
Just be aware of it.
Okay. Move on. I'm done.
No, I like that Jay's pissed about this. I'm all about this. I think we should. I love seeing him getting like.
I really thought I would get AJ fired up with the whole like America. This is un-American.
I'm leaving you guys do it. I don't need to do it. Like, you guys are doing it, and I'm loving it. I feel like we're bonding over this. This is great, guys. I'm proud of you all.
It angers me that Mauricio is not fighting this on our behalf.
Well, let me just put it this way. It's actually less work for us. It's less work for us because I'm not doing any of it. I've actually created a new company that's going to handle it because I don't want to deal with it. I don't have time to deal with it.
For free, right? Because just the benefit of being one of your clients, you're just going to take care of this for us. We really appreciate that, Mauricio. All right, let's move on to a top 10. Let's bring this back to commercial real estate.
Is this the top 10 fantasy football wins of all times?
I can't take you seriously if you got a mouthful of junk when you're trying to make a point here. But no, it's the top 10, and you wouldn't make that list because you only have 4 wins, by the way. Top 10 regional bank commercial real estate loan exposure. So we're talking about we were talking about commercial loans before, and there are certain banks that have a pretty high.
By the way, I love when Kyle says about because this Canadian just comes out big time about.
Make fun of Canada. They're not having all these problems, but if you want to talk about they have different problems. the top 10 CRE loans as a percentage of total loans for banks here. So we're getting into real like some regional banks and stuff, but they're also some pretty high percentages. So AJ made the point that it's all very regional. So if we want to talk about number one is the New York Community Bank Corp. And they have 71% of their loan portfolio is commercial real estate loans.
But what's the big deal? They've got an unlimited line of credit with the Fed under the federal, the federal banking, whatever it's called. They have no problems. They can just get unlimited money from the Fed.
How can they concentrate exposure in one asset?
I guess that's the type of bank they are. Number 2 is Valley National. They're not quite 71, but they're at 60% of their book. Then we start dropping down below 50%. And Signature Bank is 43%. East West Bank Corp is 39%. M&T, who we had a loan with, they are 34%. Comerica Incorporated is 32%. Western Alliance, 28%. PacWest, 28%. Zions Bank Corporation, 23%. And rounding up the top 10 is First Republic Bank with 20% of their portfolio.
Are those smaller ones? I know the Signature are they publicly traded? Like, can I buy stocks of that for number one?
Can I short stocks?
You want to buy stocks of the 71% exposure?
No, I'm just wondering what their stock price is when you got 70%.
Maybe buy options.
He wants to short it.
Yeah, I mean, or I'm sure the writing has been on the wall for that, and it's probably, if it is publicly traded, it's probably way down.
No, most regional banks are not.
So anyway, I thought that was interesting. You got a few of them that are 71, 60%. That's pretty high. All right, quick question here. Let's go with if you could have one free person to follow you around,
Brazilian.
would you prefer to have an assistant?
Are you bringing slavery back? What are you doing?
Just let me finish the question here.
Brazilian.
Poor Kyle.
5'9", one.
The end of the night, everybody's drunk.
Prostitute is not on the list, okay?
I'm not paying.
No, what I'm saying is that all these things are free if you could pick one. I did not put prostitute on the list. Maybe I should have, because it sounds like that's what you guys would pick. But assistant is one, chauffeur is another, masseuse or private chef. If you could pick, or let's throw prostitute on there too. If you could pick one of those, one of those 5, what would your pick be? On call, whenever you want.
Assistant.
Yeah, hands down.
Hands down.
Not even close.
Oh, that's so far from the right answer. Yeah. So I actually told Kyle this one a couple weeks ago, I think.
We talked about it.
Yeah, I'm pretty close to doing this now. I just want to get rid of my cars and Uber everywhere. If I lived in a place where Uber was a little bit more readily available, I'm kind of in a suburb where it's hard to get one, I would never drive again.
if you just had a chauffeur on call all the time, you say, I want to go here, come and pick you up. I don't think that's a bad answer, but I would probably go private chef, because that's assistant. Yes, your life would be easier, but private chef, that's like, the amount of time, and
That'd be my second two for sure. Number two for me.
you'd eat so much healthier too. And like, I feel like that'd be
I have
life-changing.
my wife is a great cook, so I've got that. My son told me a very interesting fact today, and I ran the numbers, and he's actually correct. I thought he was making it up, but he wasn't. The average American spends 6 months of their life sitting at red lights. Imagine how much, not even red lights, but just driving, how much time you spend driving, how much work you could get done if you were working every time you were in a car instead of having to drive.
So I bought my office buildings just close to my house.
Yeah, I can walk to my house.
But if you're just using that argument, them having an assistant, they're going to save probably that much time and more just by having an assistant do all their other shit. So if that's the only reason, Jay, I think I don't know if you went with the right answer. All right, let's finish this off. Mauricio, you got anything you want to plug?
I'm going to plug. What am I plugging this time? I'm going to plug my YouTube channel, because I'm almost at 3,000 subscribers.
Nice.
So Mauricio Raoul, get me over the top. I'm probably at 29.90 something. If you guys can get me over the 3,000, I got over 200 videos on real estate, syndications, macro.
And the easiest way to find your page is to go to the Drunk Real Estate page first, and that will link to your page. So it's
as long as you're subscribed to Drunk Real Estate, then you're good.
So you can just type in Mauricio Raoul, or just go to mauricioraoul.com/YouTube.
AJ, you going to plug your page too while you're at it?
I've got a newsletter that we've been doing for a while, and it's really gained some traction, and that's been going really good. So we like that. We're putting in like tons of data, a lot of stuff to find. So sign up for a newsletter. You can go to my website, selfstorageincome.com, ajosborne.com, or Instagram or anything else.
And I'm sure this is a reciprocating a relationship where you're going to plug our podcast and your newsletters too, so that it's goes both ways, right?
I always do.
Yeah.
Jay, how's it going? What do you got something to actually plug here? I gave you the last crack, so you should have had time to think of something.
I'm plugging my wife this week. So if you're waking up on Wednesday morning and you live in Southwest Florida and you're thinking, what do I have to do at lunchtime today? The answer is come to the Sarasota RIA Wednesday meeting and hear my wife speak on the topic of real estate negotiation. So she'll be speaking today, meaning tomorrow, meaning the day this comes out, at lunch in Sarasota on negotiation.
Is this the one time of the year that you plug your wife?
Well, no, that's what I was going to say. We've done we've been on the air for 3 months now, and this is Jay plugs his wife once. That's about right. Like one plug every 3 months. So
if she's feeling bad for me, then yeah, that's about right.
All right. Well, to follow that up, I'm plugging my wife again. Once again, she's much better looking than Jay and smarter too. So go follow her. Check her out on all the socials. Badash Investor. What about you guys? My clear water has been gone for a while.
I need to throw something out. One more thing. Next week is Thanksgiving. We are going to take a week off because
I objected to that, by the way, for the record.
But we're taking a week off because Mauricio apparently is going to be busy doing Christmas decorations that week. So
we're done, man. Are you kidding me? We're so done.
What is going on with Mauricio's thing? It's like it was doing random thumbs up, which I thought was good. Or whatever. Now it's doing random thumbs down.
Is it down? Really?
It did a thumbs down. I didn't know to do that.
I think it's Bethany in the background just hitting the button.
I'm pretty sure they're messing with you at this point.
Everybody have a wonderful Thanksgiving, and we will be back in 2 weeks.
Merry Christmas, everyone.
All right. Well, my drink's gone. I'm going to go hit the head. So I won't see you next Tuesday, but I will see you next Tuesday. Bye, guys.